What if I told you that inside these two books lies the map for you to not just survive but win in the chaotic stock market? This isn't guru talk, no magic formula, it's pure wisdom, battle-tested. But almost nobody tells you how to really use it chapter by chapter. Today we're doing things differently. We're tearing away the veil covering One Up on Wall Street and the Warren Buffett way. I'm going to guide you through the most important pages, the chapters that can transform an ordinary investor into someone with a real edge. Stick with me, because by the end of this video, you'll have an arsenal of practical techniques to apply tomorrow and start building your financial victory. The truth is, most investors feel like a ship adrift. Too much information, too little clarity. You buy a stock, it drops, you sell, it soars, feels like a game of chance, right? And the worst part? Many give up or fall for empty promises because the real success manuals seem impenetrable. Peter Lynch, Warren Buffett. Two names that echo like legends. Lynch, the investment chameleon who sniffed out opportunities where no one else looked. Buffett, the oracle, the master of patience and deep analysis. Their books are Bibles, but who really taught you how to read these Bibles? To extract the gold from each chapter? I've been there myself. I'd stare at these tomes and think, where do I even start? How does this apply to my reality, with my limited money, my limited time? It took a lot of dedication to crack the code. And that's the code I want to share with you today. We're going to turn dense theory into sharp tactics. Let's open the first treasure chest. Peter Lynch. Lynch's book is a call to action. He wants you, the average investor, to realize you have an advantage over the suits on Wall Street. How? By using your eyes, your ears, and your brain in your everyday life. The power of the 6 categories. Lynch doesn't lump all stocks together. He divides them into 6 categories, and understanding this is crucial for you to know what you're dealing with and what to expect. Slow growers, large mature companies, dividend payers. Not Lynch's favorites for huge gains, but they can have their place. How to use, for a more conservative part of your portfolio, seeking income. Stalwarts, giants like Coca-Cola, they won't give you a quick 10-bagger, but offer moderate growth and protection in crises. How to use, great for the foundation of your portfolio. Lynch suggested taking partial profits after 30 to 50% gains and reinvesting. Fast growers. Lynch's darlings, smaller, agile companies in innovative sectors, with the potential to multiply your capital many times over. High risk, high reward. How to use. Here's where the gold is, but it demands research and nerves of steel. This is where you can find 10-baggers, but diversify within this category. Cyclicals, auto, airline, steel companies. They rise and fall with the economy. Timing is everything. How to use, Lynch warns. Buy at the bottom of pessimism, sell at the peak of optimism. Extremely risky for amateurs. Turnarounds. Companies that almost went bankrupt but have a chance to bounce back. Think Apple in the 90s. How to use, huge potential, but the risk of failure is massive. Only get in if you truly understand the story. Asset plays. Companies with valuable assets hidden on their balance sheets, real estate, patents, even cash. How to use, requires a detective's eye on the balance sheets. You might find a company valued at $10 with $15 in hidden assets. Okay, that's a lot of categories. How will I know which is which? Hold on! Lynch himself says a company can change categories. The important thing is for you to start thinking this way, to not treat every stock as the same. Lynch had a peculiar taste for what he called the perfect stock. Forget glamour. It sounds dull, or, even better, ridiculous. Nobody wants to talk about Consolidated Rock Piles Inc. at a party. Less attention equals sign, less competition equals sign, cheaper stocks. It does something dull or disagreeable, or there's something disquieting about it, rumors of something bad. Industry X is going to disappear. If it's not true, it's an opportunity. It's a no-growth industry. Fewer analysts covering it, more chance to find bargains. People have to keep buying it. Basic, essential consumption. The lesson for you to win here? Go against the herd. The best opportunities are often where no one is looking. Use this list as an inverted filter for your ideas. Lynch was obsessed with earnings. He popularized the PEG ratio, PE ratio divided by the earnings growth rate. If the PEG is less than 1, it might be a bargain. If it's over 2, it might be expensive. And before buying any stock, Lynch did the 2-minute drill. Could he explain to someone in 2 minutes why he was buying that stock? If not, he wouldn't buy it. How to use to win. Simplify. If you can't clearly explain your investment thesis, you probably haven't understood it properly. And use the PEG as a quick thermometer. It's not a golden rule, but a great initial indicator. Lynch's world is fascinating. It gives you the feeling you can be a Sherlock Holmes of stocks. But the challenge is superficiality, thinking that just because you know the brand, it's enough. Lynch's research went deeper. Overconfidence. Falling into the trap of thinking every observation is a gold mine. Time and dedication. Yes, the idea is simple, but execution requires work. Reading reports, understanding the company's story. Are you willing to go beyond the first impression to truly investigate your ideas? Because that's the difference between using Lynch to win or just having another "I almost made it" story. Now let's enter Warren Buffett's temple through the eyes of Robert Hagstrom. If Lynch is the sniffing detective, Buffett is the empire architect. Hagstrom's book distills Buffett's philosophy into clear tenets. Business tenets, the foundation of everything. Buffett doesn't buy stocks, he buys pieces of businesses. And only if the business is simple and understandable. If you don't understand how the company makes money in 5 minutes, forget it. How to use to win. Be brutally honest about what you don't understand. Focusing on your circle of competence is your greatest superpower. Consistent operating history. He wants companies that have already proven their worth, not bets on future promises. Favorable long-term prospects. Economic moat, the famous moat. It's what protects the company from competitors. How to use to win. Ask yourself, why do customers choose this company and not another? Will this advantage last 10, 20 years? Identifying the moat is key. Management tenets, the generals of the war. Buffett only invests in companies with managers he admires. 3 traits are crucial. Rationality. They allocate capital intelligently, reinvesting in the business or returning it to shareholders, whichever is better. Candor. They admit mistakes, their shareholder letters are lessons in honesty. How to use to win. Read CEOs' annual letters. See if they openly discuss problems or just victories, it says a lot. Resistance to the institutional imperative. They don't follow the herd just because everyone is doing it. They don't buy companies just to grow the empire at any cost. Financial tenets. The numbers don't lie. Buffett isn't a math wizard, but he looks at a few key numbers. Return on equity, ROE. How efficiently the company uses shareholders' money to generate profit. Buffett likes consistently high ROEs. Owner earnings. It's the true cash flow the business owner could take out. More important than accounting net income. High profit margins. Companies with moats usually have fat margins. $1 retained equal sign. $1 or more in market value. The company knows how to use the profit it doesn't distribute to create even more value. How to use to win. You don't need to be an accounting expert. Pick 2, 3 of these metrics, understand the basics, and compare the companies you're interested in. Financial websites offer this data for free. The goal is to see if the company is a consistent money-making machine. Value tenets, the right price. Here's Buffett's masterstroke. Price is what you pay, value is what you get. Intrinsic value. What the company is truly worth based on its future cash flows. Calculating it is hard, but the idea is to have an estimate. Margin of safety. Buying the asset for a price significantly below its estimated intrinsic value. This protects you from calculation errors and unforeseen events. How to use to win. Even if you don't calculate intrinsic value precisely, understand the concept. Wait for bargains. Don't buy wonderful companies at any price. Patience here is your greatest ally in finding these deals. Buffett's wisdom is profound, almost spiritual, but applying it in the real world has its hurdles. Extreme patience. Who truly has the calm to wait years, decades? Complex analysis. Apparent, Calculating intrinsic value, understanding all financial nuances, seems like stuff for PhDs. The new thing, temptation. The market thrives on novelty. Buffett often ignores it. It's hard to resist the allure of fool's gold. Can you tune out the noise and focus on long-term fundamentals? Can you resist the temptation to do something when the market is volatile? Because Buffett's philosophy is a constant test of your temperament. Okay, Lynch showed you a universe of possibilities in your own backyard. Buffett gave you a PhD in quality and value. You've read the chapters, seen the techniques. Now what? It's a lot of information. How am I going to apply Lynch's 6 categories and Buffett's tenets? Am I going to become an analytical monk who also visits malls every weekend? This is where many freeze. Analysis paralysis. The fear of applying it wrong. The feeling that, despite having the keys, the door still seems too heavy. Is it possible for us mere mortals to really use this to win, or are we doomed to admire the giants from afar? The answer is yes, it's possible. And the secret isn't to apply everything robotically, it's to create a symphony between Lynch and Buffett. Think of it this way. Lynch is your scout, your idea radar. Buffett is your quality filter and your patience guide. One doesn't cancel out the other, they complete each other. Step 1, the Lynchian radar activated, generating ideas with purpose. Start with Lynch. Use Lynch's categories as a mental map. This company that caught my eye, does it seem like a fast grower, or a cyclical in disguise? This already gives you a framework. Do Lynch's field research. Saw a store always crowded? Ask employees politely, customers. Use the internet to read reviews, see what people are saying about the brand. You're looking for signals of a good business. Apply the 2-minute drill. If the idea excites you, try to explain why in 2 minutes. This solidifies your initial thesis. The goal here is not to buy yet. It's to create a watch list of companies that have passed your first filter of curiosity and intelligent observation. Step 2. The unforgiving Buffett filter. Qualifying with rigor. Now take your Lynchian watch list and run it through Buffett's fine-toothed comb. For each company, circle of competence is king. Do you truly understand the business? If the answer is sort of, discard it or study much more. Be honest, does an economic moat exist, and is it durable? Go back to Buffett's business tenets. Does this company have a real sustainable advantage? If it's easy to copy, the moat is weak. Trustworthy management, read shareholder letters, watch CEO interviews. Do they seem rational and candid as Buffett preaches? Financial health. Simplified, use 3 key metrics from Buffett's financial tenets. ROE, earnings growth, low debt. Is the company financially sound? Price versus value, the margin of safety. Is the stock trading at a discount to what you think it's worth, even if it's an estimate? Use Lynch's peg here too as an indicator. If it's trendy and priced to the moon, Buffett would likely say wait. You don't need to nail the intrinsic value perfectly. The idea is to get a sense of whether it's expensive, cheap, or fair. If a company has passed all of Buffett's other filters and is at a price that seems at least reasonable or even at a slight premium if the quality is exceptional, then you have a strong candidate. Step 3. Strategic patience, where Lynch and Buffett meet. If you found a company that sparked your Lynchian curiosity and passed Buffett's rigorous evaluation, congratulations! Now comes the hardest and most rewarding virtue of both philosophies, patience. Lynch needed patience for his 10 baggers to flourish. Buffett considers forever his favorite holding period. How to win with this? Once you've bought a company based on this combined analysis, resist the urge to sell at the market's first hiccup. Reevaluate the fundamentals periodically, not the daily price quote. Practical example of the winning synthesis. Imagine you, Lynch, notice that a small niche software company your business uses is gaining many clients and has an excellent product. You put it on your watch list. Then, Buffett, you investigate business. The software solves a real problem and is hard to replicate. Moat. You understand how they make money. Management, the CEO is transparent in communications and focused on the product, not crazy acquisitions. Financials, RO is good, earnings growing, low debt, value, the peg is 1.2, reasonable for Lynch, and the price seems fair for the quality and potential. Buffett, you buy and you monitor quarterly to see if the fundamentals remain. That's investing to win, using the best of both worlds. By internalizing and applying this synthesis of Lynch's and Buffett's chapters and techniques, you don't just become a better investor, you become a better thinker about business and value. You win over fear and confusion, because now you have a process. You win over superficiality, because you've learned to investigate. You win over impatience, because you understand that value takes time to manifest. You win against the market, long-term, not by being right every time, but by building a portfolio of high-quality companies bought at reasonable prices, with real-world observed growth potential. This isn't about getting rich quick, it's about building wealth intelligently and sustainably. It's about having peace of mind with your investments. That's the real victory. Peter Lynch's and Warren Buffett's books aren't just investment manuals, they are guides to developing a critical eye and a strategic mind. Lynch teaches you to find the needles in the haystack. Buffett teaches you to confirm if they're pure gold, and to have the wisdom to hold on to them. Stop being a spectator in the money game. Use Lynch's curiosity and Buffett's discipline chapter by chapter to become the master of your own financial journey. Victory awaits those who study and act intelligently. Woo! That was quite a journey through those two universes, huh? But tell me something, from the heart. Which chapter or technique from Lynch or Buffett that we explored today most opened your mind? And what's your biggest challenge in applying this to your everyday life? Share it in the comments below. Let's exchange ideas, because learning together is much more powerful. If this deep dive helped you better understand how to win using these masters, hit that like button, subscribe to the channel so we can continue deciphering the secrets of the investment world together. And if you know someone who needs to master these techniques, share this video. Good knowledge is shared knowledge.